Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
Boring inflation is about to make space rockets more profitable than your bank. Rocket Lab just agreed to buy Iridium for about $6.5 billion in a 28% premium deal that shoves them straight into SpaceX's face and locks in real cash flows from 2 million satellite devices on Earth. While CNBC drools over NVIDIA at $198, the S&P 500 just pushed to new highs, with the top 10 stocks hoarding more than 35% of the index's weight, the most concentrated since the dot-com bubble. And in the background, the Fed stays politically armored after the Supreme Court blocks Trump from firing Governor Lisa Cook, locking in a central bank that hates inflation more than it hates recessions. Here's the tension. Wall Street is pricing a soft landing fairy tale. The real trade is boring, dirty, and 300 miles above your head. Let's put numbers on this. Iridium runs a low Earth orbit satellite network with revenue around $800 million and juicy free cash flow. Not AI, not crypto, literal talk and text from ships, trucks, planes, and military hardware that never go offline. Rocket Lab is not meme stock space tourism. It's launch plus satellites plus services, the unsexy plumbing that makes every smart logistics, defense, and weather system function when the cell towers fry or the fiber cuts. This deal basically turns them from we throw stuff into orbit into we own the toll booth your signal passes through. Now look at today's headlines again. Extreme heat torching the Midwest and East. That's not just misery porn. That's more strain on power grids, more infrastructure failures, more emergency logistics, more real-time weather, crop and grid monitoring from space. Iran and US posturing around ceasefires? Translation: navies, drones, and supply chains living on secure, redundant satellite links so nothing gets jammed or lost. Defense budgets don't shrink in this script. They expand, and they pay their satellite bills on time. Meanwhile, everyone you know is overexposed to the same 10 US stocks. Your 401k is basically a closet NVIDIA and megatech fund. The S&P at 745.78 is a nice number until one earnings miss turns innovative into overweight and wobbling. That concentration isn't diversification, it's groupthink with an ETF wrapper. Now the twist, the Supreme Court shielding a Fed governor for now isn't a gossip headline, it's a message. The Fed is structurally insulated to keep punching inflation in the face, which means higher for longer rates, higher cost of capital, higher pain for cash-burning tech fairy tales. Who survives in that world? Assets with pricing power, real contracts, and geopolitical tailwinds, not vibes. Space infrastructure fits that bill way better than your favorite unprofitable SaaS clown car. So here's the unsexy mechanism nobody talks about.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Step 1. Higher rates crush story stocks and force investors to hunt for cash flow with growth optionality. Step 2. Geopolitics plus climate chaos force governments and corporations to pay for redundancy, backup communications, global tracking, real-time data. That lives in orbit. Step 3. Launch costs are falling, but the number of legally useful orbits and licensed frequencies is not. That makes orbital infrastructure a quasi-scarce asset with toll-like economics. Rocket Lab buying Iridium is not space news. It's a bet that the orbital toll road becomes the new regulated utility, except global, harder to compete with, and indexed to every disaster headline you doom scroll. While everyone stares at Bitcoin dipping 3% and Ethereum bleeding 3%, the real quiet trade is this. The more chaotic the world gets, the more predictable satellite revenue becomes. Ships still sail, planes still fly, armies still move, grids still wobble. All of them need permanent, global, low-latency eyes and ears. Here's what you learn from this. You are overpaying for narrative risk and underpaying for orbital cash flow. This is not financial advice, but here is the truth. If you only own broad indexes, you're basically short space infrastructure without knowing it. If the Fed keeps rates elevated, cash-rich, contract-heavy satellite operators and their launch partners gain power every quarter. If climate and conflict stay chaotic, demand for space-based communications and monitoring does not cycle, it compounds. So what do you do with this? 3 concrete moves to think about. 1. Audit your portfolio for concentration. Check how much of your money is actually just big tech with extra steps. If your top 10 holdings mirror the S&P, you're not diversified, you're lazy. 2. Learn the orbital value chain. Not memes, mechanics. Who builds rockets, who builds satellites, who owns the constellations, who sells the actual connectivity to ships, planes, and militaries. Put those names on a watch list and track revenue growth, backlog, and free cash flow, not hype. 3. Add boring space to your opportunity set. You don't chase whatever jumps 20% on Newsday. You stalk the stuff that prints cash off long-term contracts and keeps quietly attaching itself to the world's favorite habit, screwing up logistics and then paying any price to fix it fast. Everyone else keeps praying to the NVIDIA altar. You're going to study the invoice stack for every satellite ping that keeps heat waves, armies, and supply chains from total blackout. One is crowded, one is not. This is not financial advice. But stop worshiping the same 10 stocks and start tracking the assets the world cannot turn off, even in a blackout. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.